Ladies and gentlemen, welcome to Entrepreneurial Finance, Equity Financing. What are the general sources of equity financing? How can you obtain your financing? Well, before we look into that, look at two examples. Henry Ford, he started his company and in 1903, I think, and he launched his factory with in total $28,000 from 12 private investors in Chicago. So this is, you could call it the very beginning of some kind of angel financing. There was private individuals who gave Henry Ford money. Also, they didn't know how he uses that. There was a big uncertainty whether he's going to be successful developing a car and so on. But that was the starting point of his company. Now, on the other hand, the German company Dr. Oetker, August Oetker, he bought a drugstore and he improved baking powder. And by doing that, he started selling that to many, many other people and built his company basically stepwise. Today, it is both very renowned companies, big companies, but the one started from the very beginning with private equity, with private shareholders. The other did not. The other didn't need any money. And this is what equity financing is about. First of all, the question, how much money you need, whether you really need money, and whether you maybe also need some additional support. Henry Ford, for example, could use these 12 investors to help him building his company. So this is important basically to bring in line the requirements of financing with the possibilities. And equity financing is structured into a private equity part, which is financing privately held companies. And you can do it, as you've seen in the example of Henry Ford, very early. So the first investors Henry Ford had, that was before he started building his product. So he had nothing. Maybe he had a business plan, but I don't think he even had that. So he just had an idea and they gave him money. So you're facing high uncertainty and you are very, very much dependent on this one person, Henry Ford, and in this example. This is a typical example for early stage private equity. And then you have later stage private equity. This is typically those transactions where a company is still privately held, but it's a much larger company and a large private investor goes in and buys shares of this company. He takes this company over or he buys out old investors in some kind of buyout transaction. On the other hand, we have public equity, and public equity is the stock exchange. So everybody can buy shares from Facebook today, but it was not possible before July 2012, which means earlier on it was a private equity. When Peter Thiel, for example, invested as the first investor, it was very early stage private equity, and the company developed and now is on the stock exchange. The shares are publicly traded there. If you look at the early stage financing, it is important on the one hand that it is an equity investment. An equity investment has the business model of realizing capital gains, and also in the example of Henry Ford or Peter Thiel, giving the founder additional support to build his company. Especially if you look at the owner-manager dominance, if you look at these people who might be able to do certain things very, very well and might not be able to do other things. Maybe you need someone to support you with these other things. And this is very important in early stages. In later stages, when a company is more mature, it's not that important anymore. And also in later stages, it might be possible if a company has positive cash flows to pay out dividends or to put in debt capital to use the positive cash flows in order to pay interest rate and repayment, so to realize those buyout structures in later stage private equity investing. If you look at the public equity market, you can see that this public equity market basically functions also on capital gains. People are buying shares because they think the share price is going to rise. But on the other hand, they also live on dividends. So Deutsche Telekom, for example, was quite an interesting share because Telekom paid interesting dividends. So in later stages, having shares, having a part of a company also can mean you obtain dividends. You can see the business model changes from capital gains to a mixture between capital gains and dividends. Looking closer into early stage financing, you can differentiate that in an informal and a formal part. The informal part is what I described with Henry Ford, for example, or Peter Thiel investing in Facebook. It is private individuals that have a relationship to an entrepreneur and investing their own money. And it's called informal because they don't use a fund to invest their money. They invest their individual money and they put it as business angels into a company, or it is just friends of the company builders. So maybe also they just invested on a friendly basis without helping the entrepreneur too much. Later stages, the capital market is more formal in terms of it is formal organization that are investing in small companies. We're still talking about early stage investing, which on the one hand can be financially driven investors, so-called venture capital, and they have the pure business model of realizing financial gains, and also strategic investors, corporate venture capital programs, for example, that have the goal of financial but also strategic relevance of companies. So that is a differentiation of the early stage capital equity market. So in total, the equity market can be differentiated in a public and a private part, and the private part is the early and the later stage, and the early stage is again differentiated into an informal and a formal part. If you look at the development of companies, you can easily see that many companies start with informal early stage financing. If people start a company, Mark Zuckerberg, for example, he first of all used his own resources to build the company, then had Peter Thiel investing into his company. That was when he wasn't able to bring returns. Actually, that was when the company didn't make any positive cash flows. When the company starts making positive cash flows, so an expansion phase, it might be also interesting for banks at that point of time, because then on the one hand you have assets which might be important for banks. On the other hand, you have positive cash flows banks can use for their repayments and also the interest rate. When the company grows bigger and bigger, then it can also go public. In the case of Mark Zuckerberg and Facebook, it happens in July 2012. And then you can use all the other means, which is you do a capital increase or you do buyout transactions or whatever when your company is public over time, which is later stage equity financing.